Welcome to the Tower Wealth Advisory podcast series. I'm Tyler.
And I'm Dave.
And today we're talking about how it pays to stay invested. And really what we're talking about is volatility in the markets. And right now it's February 2022, and we have been going through volatile markets. So our comments today are around why it pays to stay invested. So let's jump into it and go to our first slide. How do you reduce anxiety when markets fall? Well, the answer is simple. It's not simple to do, but it's stay invested. And so we're going to support that comment, I guess, through these slides. So bad behavior, it's only natural. Dalbar is a U.S. research firm known for its studies of investor behavior. Researchers there have identified 9 behaviors that can lead to weak investment performance. And of the 9, 3 stand out as the most detrimental. So those 3 bad behaviors are ones that we're all susceptible to. The first one being loss aversion. This is our natural fear of losing money, and it can lead to you withdrawing capital at the wrong time when markets are already falling. So that's when you're going to want to pull money out, is when things are going down. Anchoring is the second one. This is the tendency to falsely believe that events and conditions from the recent past are more important and are worth greater consideration than older events. And herding, and I think it's more referred to as FOMO now, fear of missing out, it's doing what everyone else is doing just because everyone else is doing it. So if other people are selling their investments, maybe I should too.
I think a big part on this, and this is, we're in the advisory business, so we guide our clients through this. We have lots of discussions. It's not like we don't get calls when things go bad, but we don't get nearly as much as what you would read in mainstream media about, oh, you know, the sky's falling, all of this. And so when we talk about active management of investments, we're trying to find managers for our clients that do well in the markets. And, you know, a lot of what we look, you know, there's so many things we measure a manager on, but a big one that we like is how much of the market do they capture on the way up and how much in the market do they capture on the way down. And, you know, we're looking for someone who captures, you know, all or more on the way up and half of the downside, and then you'll get a decent return. But we're trying to compare with, say, somebody who's just going to go out and buy an index fund for a stock market. And this is the issue that happens when, you know, loss aversion. You know, when that market goes down, it's way more volatile than, say, what our managed active portfolio is. And people can't handle it. It goes down and they eventually bail. Mm-hmm. And then they try and jump back in, and it just doesn't work. So if you're somebody who can handle volatility and you just bought an index and you decide you didn't need an advisor to pick your investments, you can ride that forever and make lots of money. But these 3 things will kick in on most people at some point without any advice.
It's true. And we do get into that about the value of having advice.
There we go. I jumped ahead again.
That's okay. So success quite often can be measured in days when you're looking at performance. I found this chart really interesting. And what we're looking at here is U.S. stocks. This is January 1992 all the way up to December 2021. And you've just invested $10,000 back in January 1992. So if you stayed invested all days in the U.S. stock market, your $10,000 would be worth just about $210,000 in 2021. If you'd missed the best days, so if you did what you're not supposed to do.
10 best days, yeah.
Yeah, and you missed the 10 best days, meaning you uninvested, you were out of the market for those 10 good days, your investment only grew to $95,000. And if you missed the 30 best days, your investment only grew to $35,000. And if you missed 60 of the best days, you barely made anything, and you were up to $11,000 after your $10,000 contribution. So that's pretty significant. That's only 60 days in that long time period. If you missed those 60 days, you made no money.
Yeah,
it's crazy, right?
It's very interesting, and maybe this isn't the right time for this input little story, but you know, for years, my uncle was retired early, very active. I mean, he was a portfolio manager without the designation. I mean, he spent every day on research. He spent every day on his portfolio, and there was many days at the end of a trading day, he was 100% cash. And then he would wake up the next day and decide whether he wants to go back into the market or not. And he would do various things, you know, currency hedging, all sorts of stuff. And I know he'd compare with my father, who was a client of ours, and they would compare rates of return at the end of the year. And I always remember my uncle being extremely frustrated for all the effort and time he put into it and in and out of the market that he lost most years to my dad. And I think my dad enjoyed that because he wasn't spending 10 hours a day on his portfolio type thing. So it's interesting. Even a person who's really good, he didn't end up losing out like missing the 10 best days or the 30 best days because he was somewhat skilled at doing it. But for all the effort that he did, he certainly couldn't even keep up with just a market return.
Right on. Yeah, and these kind of charts are compelling when you hear it. So we'll jump to the next slide. So again, success being measured in days. This again is a chart 1962 to 2021. This is Canadian stocks negative and positive years. So to put a little background here, you can see that 16 years were negative years in that period of time, and we're looking at a 60-year time period here, and 44 years were positive, and not just positive, but greatly positive. 18 of the years in that period of time were over 20% returns in the marketplace.
And only 2 were under 20, down 20%.
That's right.
Yeah.
So again, historically, a positive annual return from the stock market has occurred much more often than a negative one, and we can see it here.
Yeah, I mean, even the graph on the 2 in the middle, 0 to minus 10 and 0 to plus 10, well, they saw off. So then you go the two extremes. 10 to 20, you had 14 up and 4 down, which in the same band, just on the wrong side of the ledger, and then 18 to 2.
Yeah.
So
way more positive.
Yep.
And I think this next graph actually shows that in a bit more detail. This really stands out to me where you look at periods of time, in 2000 when we had a massive bear market, 2008, another massive bear market, but they're blips when you look at the history of performance. So your bull market's providing far more return and for far more of the time than a bear market.
Yeah, so, and even right here at the end, I've always kind of never really saw the pandemic 3 weeks as a bear market.
Yeah,
but in essence, look how much it fell though, right? Like it
fell a lot very quickly and recovered very quickly.
Yeah.
So you can see in the top there, the bull markets, their average duration of a bull market was 53 months. You're going to spend 53 months in a period of positive performance. And the average cumulative return during that time is up 105%. That's the average. In a bear market, on average, bear markets are down 13 months. So about a year, you might deal with down markets. And their average down period of time there is a minus 33% return. So the gap between those two are just huge, significant. So let's jump to the next slide here. One of the things that we do have to be very sensitive to is, when we're in a bear market, the amount of loss that your portfolio can experience. Because when it comes time to recover, you're going to have to produce a better return than what the negative performance was because you're working with a smaller number. Yeah. So some people might think, well, I lost 20%, I need 20% to get back to where I am. No. That's not the case. And you can see it on the chart. If you were down 20%, you need to get 25% to get back to where you were.
Well, the 50 and 100 is the prime example. If you lost half your portfolio, you'll need 100% return.
You need 100% return to get back.
Even, yeah. That's crazy.
So it is significant, and really what it points to, if we go to the next slide, is that we want to build diversified portfolios that mitigate and manage risk. And you touched on it, Dave, is we're trying to find portfolio managers that capture as much of the upside as they can and as little of the downside as possible. And so when you put managers together like that and build diversified portfolios, you're trying to create what you can kind of see on the side here, but I think we expanded in a larger chart.
We have a big part here.
So if you expand this and look at our next slide, it can be a little, busy here.
But bingo squares.
Yeah, what you want to look at is the darkest colored squares that seem to kind of focus around the center of this chart. And that is a 60-40 portfolio. That's a very old school way of creating portfolios, but it is speaking to the diversification of a portfolio where 60% of it is in equities and 40% is in fixed income products.
And all, look at it. It's all middle ground returns and not one negative year.
That's right.
Got close in 11 and 18. What's interesting with this is when we talk about managed money and how we do things, we manage not a 60-40 portfolio. We're more of a 50-25-25 because we use, a lot of alternatives. But the key here is we're putting money in these different areas. If you look at U.S. stocks, Canadian stocks, real estate investment trusts, global stocks, emerging market, gold, global bonds, Canadian bonds. So when we build a portfolio, it's just not a static portfolio, but we don't chase to try and catch, the best emerging market return that we should have been in 2017 to get 28%. We don't take the portfolio and slide it over. We'll tactically allocate money and overweight certain sectors, certain regions of the world because we are looking at all of the available data. And that's how we try to improve the return by 1 or 2%. Certainly if we were trying to get that top line there, the best return in any given year, it's impossible.
It changes dramatically. And again, it becomes a timing thing, just like one of our first slides here was, if you're out of the market for 10 days, you've lost half of your return in that first example.
Yeah.
So you're touching on 2017 where emerging markets did plus 28.3%.
Yeah.
What'd they do in 2018? They were -7.
Yeah.
So that's just a 1-year switch. And did you have your finger on the button at the right time to get in and out of that? That's really difficult to do. So buying the diversified portfolio, tracking along the center line takes a lot of that volatility out of it.
And it's unfortunately boring. I mean, and that's
boring,
why, for the most part, when we manage our clients' money, it's a good balanced portfolio and it's boring. And so sometimes they have a little side pot that they like to have that's not boring. So it can get pretty exciting for them.
I mean, it's still done very well. You look at a 60-40 portfolio, we don't have the average return over that time period, but you look at your 19, 20, 21, everything's floating around 15, 11, 12% returns annually there. I mean, those are good returns still. Yep. And depending on your appetite for risk, I mean, that might be perfect for you. Also, depending on whether you're prepared for retirement or not, that should be, good for you, but you might be required to be more aggressive with your portfolio because you haven't saved enough. So that's difficult. So if we go to our next slide, there is a cost to protecting your capital as well. I mean, we can't just go and sit in a GIC, a guaranteed investment certificate, due to inflation. So there's a lot of talk about inflation right now, and that's eroding the ability of our money to go out there and buy products. So if you're buying GICs, basically since 2012, we haven't had a year where a GIC has posted just a flat return. When you take inflation into account, you're technically posting negative returns. Your GIC is paying out interest income. 2021, most recently, I think the average 1-year GIC was maybe 0.5% performance return there, and then you're staring at 3.5–4% inflation. So your negative performance on those products. You have to be involved in the market. Is really what this slide is pointing to.
The part that's not even on here is before inflation, after inflation. So that's your return in blue. Mm-hmm. Take off your tax, and then take your inflation down. That number would be
is not tax adjusted.
Yeah, it's crazy. Yeah. It'd be even larger. And let's face it though, there are people who are still in GICs. They have been. They've never left them. And for them, either they've just got pools and pools of money, or they live very thinly. But sometimes for individuals in that position, they've just taken all the other considerations off the table, and they just want the guarantee. They don't care if they're losing money, and a lot of times they don't see the green bar here. Mm-hmm. They just know, hey, I got 4% this year. Yeah. And to them, they go, I have $1 million. I got 2%. I made $20,000, even though they paid $8,000 in tax, and the cost of living went up more than their $12,000 net gain. They don't see that. They just see 20,000, and they don't want to look at any other numbers a lot of times. Yeah. Sorry, not to pick on the GIC people. There's not a lot of them in the world. But.
No. At the risk of failing to meet your goals because you haven't invested properly is what we see there. Points to remember. These are just points that kind of summarize our slides here, but history has shown that markets go up more than they go down, and there are many more positive periods than negative ones. Your portfolio can suffer heavily if you miss even a few days of the best days in the market, and you never know when they're coming. Timing the market is impossible. Limiting losses is crucial to generating the long-term returns you need to meet your goals. Diversification is a time-tested strategy for helping limit losses and for smoothing out your investment experience. And of course, the longer your time horizon, the smoother your investment journey, and the more likely you are to generate a healthy return.
Remember we had the graph before, it was the motions of investing. We should have thrown that one up, but it's looks like an S curve. Oh, yeah. So you had your straight line across horizontally, and then you had this curve. And do you remember the term at the very peak?
Wasn't it euphoria?
Euphoria, yeah. And then what was the various?
Despair.
Despair, yeah. I think capitulation was just before despair. Right? So,
capitulation, when you're
but if you think about just those emotions, and this is, these are people who potentially could be market timers or make that one-time decision to do something that they shouldn't make the decision at those points, but it happens. But if you think of not elation, but euphoria, if you just think about that and think about the emotion around that and think about when you're talking with everybody if everyone is euphoric about the stock market, you are probably near the very peak of a market. Yeah. And when everybody, the world's horrible, this is not working out, investments suck, my job sucks. I don't know, the combination of all those things, that's like time to invest.
Maybe I should be investing, yeah.
Who was it, the Rothschilds or whatever? When there's blood in the streets, we invest.
Oh, yeah. Yeah, I thought that was Buffett.
I might be tainting them with the wrong brush.
That might have been Buffett too. I don't know. So our next slide here. So strategies to consider when you're building a portfolio is obviously sticking to a plan, number one. And this is where we would certainly highlight that you work with an advisor. We want your advisor to create a picture of your future and then establish a simple, easy to follow plan for making it a reality. Secondly, we want to put financial noise in perspective. So you may have been told to ignore or tune out anxiety-inducing market headlines. Because of our natural human biases, we're going to want to do things that are adverse to our portfolio performance.
Yeah, I think in simple, to stick to the plan, even from a very simple plan, we find, over the years, what really worked was people didn't know how much money they needed. And so once you determined how much you would need for, say, retirement as a goal, and you basically could backward the numbers, use an average rate of return of a 60-40 portfolio back then, or a 60-20 or 50-25-25. And all of a sudden you tell someone you need to set aside $700 a month and everything else is yours to do whatever you want. And they're like, oh, that's it. And people save $700 a month. And 30 years later, like, I've got my retirement money. So it is simple sometimes, but it's like you said, the second part of that is you got to filter out the noise. So it's when you make the wrong move with that plan and bail on it for something richer, sexier.
The FOMO.
The FOMO fear of missing, shifting your portfolio around.
Next strategy to consider: regular rebalancing. So for some people who aren't working with an advisor, they're trying to regularly rebalance their portfolio. For those who aren't working with portfolio managers like you and I, their investment advisor has to get in front of them in order to do a rebalance on their portfolio and bring it back into the scope that it was designed to be in. But for you and I, this is something that happens in the background. Is that how you would describe it?
We're discretionary money managers, so we get to rebalance a portfolio for a client when it's time to rebalance, bringing their asset allocation back into line without having to consult the client. Now, we do have an investment policy statement with the guidelines of what we can do for that client, so we stay within that. But anybody who's running their own portfolio, anybody who has a pool of investments at their bank, you are actually the advisor. Even though there's somebody at the bank, you have to make the decision. They won't. And they're not sitting down with you 3 times a year, twice a year. So, even in a growth period, your asset allocation is going to fall out of sync. You have to bring those numbers back in line, and that's important to do some regular rebalancing. So it's not about buying and selling and, selling the winner and finding the next winner. It's just about keeping your asset allocation intact for the long term.
Yeah, you're right. In a growth period, people don't think of seeing their advisor to rebalance. But in a growth period, your asset allocation will have your high growers grow very quickly, and now you're out of scope. So when you go into a period of volatility, now your portfolio has been overweighted into the high risk stuff, and you're going to experience more of that volatility because you didn't shave some of that risk off. Yep. Great. So we'll go on to the next slide. All-in-one portfolio solutions. Instead of building a portfolio from various individual funds, consider investing in a multi-asset solution where you can get a fully diversified portfolio with just one decision. So this is, again, comments towards people who are maybe working through their banking institution, aren't getting that regular rebalancing done. But for guys like us, or if you're working with guys like us who are discretionary portfolio managers, that rebalancing is happening internally on your behalf. So you wouldn't be buying a multi-asset solution yourself. You'd be looking to us to craft a portfolio for you that we then manage.
That really equals a multi-managed solution. So if you're running your own money and you're not actively acting like a portfolio manager, not actively monitoring that money, you're probably better off finding a one-ticket solution that's a balance. And I don't mean going and buying a balanced fund. I mean finding that one ticket that's got a lot of the different asset classes mixed in, not just equities and bonds. You got to find something that's got a lot more pieces to it.
Yep. And finally here, work with an advisor. So this is our plug, of course. We've got to say this.
I think I've said that about 10 times.
But this gives you some numbers to it. So households that worked with an advisor for at least 15 years accumulated almost 4 times more financial assets than non-advised households. This is according to a 2016 study. Perhaps even more eye-opening, the study shows investors who left their advisors between 2010 and 2014 lost 34% of their asset values. Investors who kept their advisors saw asset value grow by 26%.
Yeah, I would agree with that because obviously we're in the business. It would be like saying, no, you don't need an advisor, go somewhere else. And our compensation generally is tied to the improvement of the client. So as the client does well, we're paid based on the amount of assets. So we do well. That's one part. The second part would be somebody who doesn't have an advisor. It's not that they're just not going to do as well because they make bad investment picks. It's partly because they're not getting advice on general everyday things like buying back their pension, paying their mortgage down, what mortgage to buy for what term, buying a car. So, when we have a client phone looking to take out $60,000 for a car, you and I run through a lot of different scenarios. Now, because generally you can, if you've got good credit and things, there's lots of ways to work with a car and keep your investments intact, or both. Whereas somebody who doesn't work with an advisor might just be inclined to take that chunk of money, buy a vehicle, they get taxed on any growth they had. Like, it's just, there's so many things that happen from an everyday financial decision that sets you back. It's not just rate of return. So
very true.
Yeah. You see pixelating the screen.
Pixelating the screen. So I'm going to jump to the next slide before it completely falls apart.
Yeah.
This is simply just back up to the graphs that we've already shown you guys. If you need to drill down into this slide, you're certainly welcome to. It's all disclaimers. I think we've summarized what we wanted to say here today. Ultimately, it is, stay invested, make sure that you're working with an advisor, and have a plan moving forward. Yeah.
I mean, we're here, February 2022. We expect, the next 6 months to be pretty volatile. There's a lot of things happening in the world right now. Is it any different than the next 6 months at any point in any given year? Well, this one could be a little bit more exciting than normal, but this is more prevalent than to this situation. That don't get flighty, because it could get a little bouncy.
Don't sell at the wrong time.
Yes, exactly.
Well, thanks very much for watching this episode of the Tower Wealth Advisory podcast series. If you want to learn more about us, go to towerwealth.com or follow us on social media.